It is nice to meet you.
Hello everybody and welcome back to the channel. In this video where we are today going to look at three very interesting companies in the wind energy sector. We're going to focus on some of the wind turbine manufacturers, and we have selected three different ones to you. The first one is General Electric. The price as of today is 11.33. The market cap is 99.3 billion. As you can see, over the last 12 months, General Electric, which is obviously a huge conglomerate where the wind part is only a fraction of the total company, is part of, and they have been struggling a lot. So over the last 12 months, GE share price has actually tumbled with 2.83%, and over the last years it has really struggled, General Electric. Then we have Vestas Wind Systems from Denmark. The price today is $218.08 US, and the market cap is around $44 billion. They are the biggest one in terms of capacity as of today, and as you can see here from the graph, they have obviously had a tremendous run up over the last year, and they have netted 105.02%. The last one, and the one that has gained the most, is Siemens Gamesa. The price is $41.77 US, and the market cap is 28.2 billion, and over the last year they have gained 123.32%. As you can see here, it seems like the top during January, and they have then struggled over the past weeks where some of the stocks have dropped with around 10%. But again, similar to some of the other renewable sectors, the wind energy has really gotten a boost over the last year, and especially the presidential election obviously also helped a lot, because there's coming an increased focus on investment in renewable energies, and the wind sector is going to be a key ingredient in that. So we can move to the next slide, which just shows the top manufacturers of wind turbines globally. And as you can see, you have Vestas here. They're the biggest one on 9.6 gigawatt. Siemens Gamesa, the next one with 8.79 gigawatt. Then you have Goldwind, a Chinese company with 8.25. They have really increased their presence and market share over the past years, and they have overtaken GE from the third spot, which only has 7.37 gigawatt. Again, as we just mentioned, a huge increase and focus in the renewable and also in the wind industry. And basically in 2020, there was a 24% jump in orders. And this is expected to continue in the future for the sector. If you see some of the numbers of how many windmills or how many solar panels that is needed to replace some of the fossil fuels, it is mind-boggling numbers, and basically therefore these sectors are expected to experience significant growth in the coming decades. Interested in understanding whether these companies are earning any money in the end of the day. So if we look at the net income for the last year, we can see that Siemens Gamesa actually had a negative of 1.1 billion US. Vestas had a profit of around 600 million, and GE had a profit on a conglomerate level on 3.3 billion. It's very important to note that out of this, the goodwill impairment or write-off, Vestas and GE had considerable write-off in the business, while Siemens Gamesa had nothing. If you look at the net profit margin, we can see minus 10% for Siemens Gamesa. They have had a really challenging 2020, which is interesting when you put that into perspective of seeing how much the share price actually have gone up. So there's not a correlation between the two, at least for them. Vestas, a bit better number with 3% and 4% for GE. If we look at the Beamish M-score, it's a mathematical model that determines whether the company has manipulated its profits. We want this to be below minus 2.22, and there's no worries whatsoever for any of the companies. Sloan ratio is another one that identifies if a substantial part of the earnings are non-cash accruals. We want this to be between minus 10 to 10%, and as we can see here across the board, it's looking fine. Minus 11% is not really a concern from GE. So if we take a look at the overall ranking, what we can see is the trend for these stocks. They are all in uptrend as of today, although some of them, Siemens, Gamesa and Vestas, have been struggling a bit for the past 2 weeks. Then we have on the net income part, Siemens Gamesa negative, the two others are positive despite having impairment and write-offs. On a net profit margin, Siemens Gamesa not delivering well with the minus 10%. Vestas and GE are delivering acceptable results, let's say it like that. We then move into the return metrics and we want to understand how high returns and cash flow margins is being generated by these companies. And if we first look at the return on invested capital, the ROIC, what we can see is that Siemens Gamesa, again, not delivering too well with the -3%, while as Vestas is doing really well with 13% and GE a small 1%, so really nothing to write home about. And again, benchmarked against the industry, it doesn't look fantastic for these companies, but we would say they belong to a more generic industry and they should probably kind of like have their own to be benchmarked against. So take the red colors with a little bit of grain of salt here. On the levered free cash flow margin, it's looking really well for Siemens Gamesa, a bit surprising with a 7%, while as Vestas a bit more disappointing, only 2%, and GE again relative stable, 3%, nothing really extraordinary. On the balance sheet, we obviously want to understand how strong the financial position is, and if we look at the current ratio, in general we want this to be above 1, and Siemens Gamesa is the only one not living up to that, and that's a small red flag for us. It's not a huge one, but it's just one to take notice of. On the cash ratio, this is very capital intensive industry, so we wouldn't expect them to have too much cash at hand, and we can see here that it's not really good on a number basis, but again, Siemens Gamesa still has around 2 billion, 3 billion for Vestas, and obviously GE, which is a big conglomerate, has a huge money tank on $86 billion, so it's looking quite solid for them. On the total assets versus total liabilities, in general, we would like this to be above 1.5, but we say overall, okay, it's looking quite okay, but again, nothing extraordinary for any of the companies. On the debt equity part, both Siemens Gamesa and Vestas are doing quite fine, while it's a little bit high on GE's side on 2.21. So again, we don't really like that. It's a small red flag for us, but considering the other numbers that we are seeing, it is not a huge concern. We would say that GE has a relatively strong balance sheet overall. The Altman Z score, it's obviously a credit strength test that assesses the likelihood of bankruptcy. We want this to be above 1.8, and here there is a small red flag for Siemens Gamesa, which is no surprise when we look at the other numbers across the board that we have just investigated. They are not as solid as both Vestas and GE are. This is also reflected in the Piotrowski score, which is another way to assess the strength of the company's financial position, and again here Siemens Gamesa is scoring the worst of the three. It's not like huge red flags that we are seeing, it's just a statement too that two of the companies seems to have a better balance sheet than Siemens Gamesa has. So again, here in the overall ranking, so to summarize what we saw on the return on invested capital, Vestas doing a lot better than both GE and Siemens Gamesa, who had a negative, while as in the levered free cash flow, Siemens Gamesa was a bit surprising here with a strong solid 7%, while as the other one were around 2 and 3%, so nothing really spectacular, but neither bad. We looked at the balance sheet, the title ratio, and the debt equity, and overall, although the numbers for those two metrics look relatively well for Siemens Gamesa compared to Vestas and GE, from an overall perspective on the balance sheet, Vestas and General Electric actually appears to have stronger number, more solid overall than Siemens Gamesa. So you need to keep this in mind when you at least look at the overall perspective, because here we're only looking at two of the numbers, but from a general note, Vestas and GE is a little bit stronger. We then move into the shareholder yield, and we want to understand how much value is returned to shareholders either through dividend and or buyback. And as we can see here for the dividend yield, all of them are paying a small, nothing spectacular dividend yield between 0.14% all the way up to 0.55% for Vestas, but it's definitely not something that you should chase if you're necessarily a dividend oriented investor. On the buyback yield, we can see that also Vestas had a small buyback. So overall, small, nothing spectacular in total shareholder yield. If we look at the modified payout ratio, what we could see is that Siemens Gamesa could actually increase there if they wanted to. Vestas does not have a lot of room to increase their dividend and or buyback, but they could a little bit if they wanted to and still stay below 100, which is obviously what we want to see because it means that they have covered it through their earnings. And GE also has quite significant room to improve their yield if they wish to. If we look at the earnings per share growth, we basically want to understand if these companies are expected to grow in the future. And as we stated clearly, the wind sector is expected to grow significantly over the coming decades, and definitely these companies are going to benefit from this. And what we can see is, if we look at the EPS for the last 12 months, and we benchmark that with the earnings per share forecast for the next year, we can definitely see that both Siemens Gamesa and Vestas are expected to have significant growth in their earnings per share, which is obviously positive, and GE is expected to be fairly stable over the coming year. If we look at the expected earnings per share growth forecast for the next 5 years, we can see that Siemens Gamesa is expected to grow the most with 80% on a compound annual growth rate, while as Vestas will only grow with 23%. To this story is obvious that Siemens Gamesa is coming from a poor standpoint, while as right now Vestas is looking a lot stronger. They are providing positive earnings to the shareholders, so it needs to be taken with a grain of salt. GE, small decline with 2% on an annual basis, so it kind of like continues the story that GE has had as a conglomerate over the past few years, where they have been struggling a lot, and it seems to be that will continue. This does not mean that the energy part related to the wind sector is going to experience the same, but from a conglomerate perspective, which is basically what you're investing in, when you invest in GE, you're getting the full package. It is expected to decline overall, so please keep that in mind. If we look at the revenue growth for the last 12 months, as again you can see here, retraction in Siemens Gamesa on 7%. This is one of the reasons that the share has been struggling a bit. The revenue growth has simply not been there, while as if you look at Vestas, a 40% growth, really strong, and GE on an overall company perspective, a decline on 26%. So no doubt that Vestas have done better than these companies from an overall perspective. And this is the same story if we look at the net profit growth for the last 12 months. A huge setback on Siemens Gamesa on 755%. Again, the net profit growth on Vestas has also declined with 24%, but again, compared to the others, insignificant, while as GE has declined with 162%. So it's really not good numbers, and it's really something you need to take note of, that the performance in the last year of especially Siemens Gamesa, but also GE, has not been up to the previous history. So back in the overall overview, if you were a dividend or shareholder yield oriented investor, none of these companies should be on your top priority, simply because it's not a focus for them. They are more focused on growing their business. If we look at the earnings per share growth forecast for the next 5 years that is expected, Siemens Gamesa by far is considered to be the one that's going to have the highest growth, but please keep in mind that they have also been performing pretty poorly over the last few years. Vestas doing quite stable, quite good, strong, solid company. And GE, again, not expected to have significant growth, neither expected to have significant decline. So they're kind of like in a stagnant kind of phase. On the revenue growth part, it was only Vestas who had delivered an acceptable result over the last year. On the net income growth, all the companies have been struggling, but Vestas have definitely been struggling less than both Siemens Gamesa and General Electric. We then want to move into understanding whether there's value to be captured today from these companies. One way is to look at the PEG ratio according to Peter Lynch fair value. If it's below 1, it means that they're undervalued. Above 1, they're overvalued. For Siemens Gamesa and General Electric, due to the negative PE ratio or the earnings growth forecast, we cannot assess it from them. But Vestas appeared to be overvalued from this metric as of today. We can also take a look at our own estimated intrinsic value for these companies, which is based on a lot of different numbers and assumptions. And based on what we are seeing at the moment, there's an upside and downside on the companies. For Siemens Gamesa, we see a downside on minus 10.88%. On Vestas, we're much more bullish, plus 16.22%. GE, a small 2.47%, nothing really extraordinary. On the beta ratio, we are just illustrating the stock's volatility in relation to the overall market. If it's above 1, it means that it's more volatile. And as we can see, Siemens Gamesa and GE are more volatile than the general market, whereas Vestas is slightly more stable. We can also look at some other metrics. One of them is the book value per share ratio, and here we want it to be above 1 because it means it's undervalued. If it's below 1, it's considered overvalued. And as we can see across the board for all 3 stocks, they are all considered overvalued. You can also take a look at the relative strength index for the last 14 days. If it's below 30, it means it's in oversold territory and may go in an uptrend, while as if it's above 70, it's in overbought territory and may do a pullback. And again, here we can see all the numbers are in the middle range, so there's no clear indication in which direction the stock may go according to this metric. Finally, we can look at what the analyst perspective is, and definitely we want to be a bit cautious with this in general because they sometimes have their own agenda, but we think it's still interesting to see what their consensus price target says in accordance with our own estimation. And keep in mind, the consensus price target is the middle ground of all the estimates. Some analysts will have a higher price target, some will have a lower. But basically what they see from today's share price is a downside of 21.46% on Siemens Gamesa, a 16.45 downside on Vestas. So here we are in clear disagreement with them. We definitely see a higher upside than a downside on Vestas. And on GE, they see a downside on 9.97%, which again is different from us. We see a slight upside on GE. However, the numbers in accordance to which assumptions you put in can obviously fluctuate a lot. But we are definitely in disagreement with their downside estimate of GE as of today. So finally, based on all the assessment that we just looked at from a value perspective, what we consider is that Siemens Gamesa as of today is overvalued. Vestas is undervalued, however it is not significantly undervalued, and GE appears to be quite fair valued. And that leads us then to the verdict of these stocks. Well, basically it's a high growth sector. And what we want to stress is there's not a huge amount of companies within this space. It is much more limited competition than, for example, in the solar industry, which is very easy to enter into. So there's generally high entry barriers. And these 3 companies, together with a few others, are definitely dominating the market. And this is an important point to note, because high entry barriers means less competition from new companies, and therefore we believe that more or less all these companies are going to benefit from the growth that the sector is going to experience. We really have great expectations for the wind industry going forward. That being said, look at it from today. We think that Siemens Gamesa, the share price has increased significantly over the last 12 months, despite they have had a more challenging year or two. And based on this, and based on our value assessment, they're definitely not our first choice as of today. We would like to see a pullback in Siemens Gamesa before we would move into them, simply because they have struggled quite a bit, but still experienced significant share price growth. So that tells us that that is not because of their own fundamental numbers, it is just based on the expectation of the industry push that has been. If we look at Vestas, it's a bit different story because they're definitely our number 1 overall pick. They have solid numbers across the board, except the net profit margin growth over the last year. What we also want to stress is that Vestas is we have mentioned before, them and Siemens Gamesa, they are pure play companies, which means that you only get the wind industry part when you buy into them, while as when you buy GE, you get the conglomerate. Siemens Gamesa is obviously, the parent entities. You have Siemens, which is a huge conglomerate. Vestas do not have that. So if we look at all the 3 companies, we actually see that Vestas could be a potential acquisition target in the future. And obviously, we believe that due to the competition circumstances within the wind turbine industry, this will come with a premium if this is going to happen. And that's just another side benefit that we see with Vestas, that they are a much more likely acquisition target than the others are as of today. And finally, we have GE, and the conglomerate has faced challenging times. It is a cyclical stock, which is expected to have a good 2021. We would say they are semi-risky play in the sense that that is not necessarily going to happen, but GE has definitely been beating down significantly, and that's also why we don't see a huge downside with them as of today. However, we would also say that due to the struggles that they have had, they don't appear to be a safe pick. So again, if you look at all the 3 stocks, Vestas definitely number 1, Siemens Gamesa, GE, they're not bad, but they're neither fantastic opportunities, at least according to us. This was all we had for today. We really hope you enjoyed this video. Please subscribe for future content. Please give us a like, it really helps with the algorithm. Please provide a comment in the comment section. We definitely do not know everything about these companies, and we do always appreciate to get your input and viewpoint on these type of companies. And again, also to help the community, because we may have missed something in our assessment. Besides that, there's not much more to say than have a great day, stay safe, hasta la vista, baby.